Stop. Before you scroll away, look at your bank statement. See that life insurance payment? That premium? You're secretly asking yourself, am I being a fool? Is this just money I'm throwing into a black hole? We all do, because right now, that payment buys you nothing but a piece of paper. But here is the single, terrifying truth your agent won't tell you, and your bank statement hides. That payment isn't about your life. It's about protecting the lives of the people you leave behind. You see, most people think life insurance is an investment in the traditional sense. It is not a savings account. Comparing it directly to the stock market or your retirement fund is a category error. At its absolute core, life insurance is a financial risk management tool. You are engaging in a simple, centuries-old transaction. You are transferring a specific, catastrophic financial risk from yourself to a large company. In exchange for a relatively small, predictable premium, they agree to assume the enormous, unpredictable risk of your premature death. Think of it like a seatbelt. You don't buy a seatbelt hoping to get a return on your investment. You wear it to manage the risk of a car crash. You hope you never ever need it. But if you are in that severe accident, it becomes the single most valuable thing you have. The waste isn't in wearing the seatbelt. The waste would be suffering the catastrophic consequences without it. So the question flips. It's no longer, do I get a return? The real question becomes, what specific financial risk am I trying to cover, and is it a risk I need to transfer? This is where we move from theory to your specific life. Because whether life insurance is a waste or a wisdom is entirely determined by your personal circumstances. Let's break down when it is absolutely not a waste, when it is in fact a cornerstone of responsible adulthood. First, and most importantly, you have financial dependence. This is the non-negotiable primary reason for life insurance. A dependent is anyone whose financial well-being is directly tied to your income or your labor. This is most obviously a spouse who relies on your salary to pay the mortgage, or your young children who will need food, housing, and education for years to come. But it could also be an aging parent you support, or a disabled sibling. If your death would create an immediate and severe financial crisis for another person, if it would mean they could lose their home, their lifestyle, or their future opportunities, then life insurance for you is not a waste. It is a lifeline for them. You are paying not for your own benefit, but to create a financial airbag for the people you love most. It is an act of responsibility, and in many cases, an act of love. Second, you share significant debt. Debt does not die with you. If you and your spouse are jointly on a 30-year mortgage, that entire balance becomes their sole responsibility. The same is true for co-signed private student loans, business loans, or even substantial credit card debt. The tragedy of a death can be followed by the second tragedy of financial ruin for the co-signer. Life insurance can provide the capital to wipe that slate clean, to hand over a paid-off house instead of an unaffordable monthly payment. It grants the survivor the gift of time to grieve without the crushing pressure of debt collectors. Third, you are a business owner. For a small or medium-sized business, the death of a key owner or partner isn't just a personal loss. It's an existential threat to the company. There are often buy-sell agreements in place, or the need to hire a replacement, or simply the need for liquidity to keep the doors open while things are sorted out. Life insurance can fund these agreements seamlessly, ensuring the business survives to support the remaining owners, employees, and the deceased family. And fourth, on a simpler level, you wish to cover final expenses and leave a clean legacy. Even someone with no dependents might not want to leave their family with the burden of funeral costs, which can easily reach $10,000 or $15,000, or any lingering medical bills. A small, affordable policy can be a final act of consideration, sparing your family both financial stress and administrative hassle during a deeply painful time. Now, let's be equally honest about the other side. When is life insurance likely a waste of money? First, you are single with no dependents. If your death creates no financial hardship for anyone, if there is no one relying on your income to maintain their standard of living, then the primary engine for life insurance doesn't exist. Your death is an emotional loss, not a financial catastrophe for others. For a young, healthy, debt-free single person, paying for a large policy is often an unnecessary expense. Second, you're already financially independent with no dependents. This is the concept of being self-insured. If you have accumulated enough wealth that your assets can easily cover all your final expenses, debts, and still provide for any legacy you wish to leave, then you have effectively insured yourself. Paying premiums to an insurance company becomes redundant. Third, and this is a major source of waste, you buy the wrong type of insurance for your need. This is critical. There are two broad categories. Term life insurance is pure protection. It's like renting coverage for a specific period, 20 or 30 years, for example. It's straightforward and remarkably affordable. Permanent life insurance, like whole or universal life, lasts your entire lifetime and includes a cash value savings component, but it is significantly more expensive. The waste occurs when someone who simply needs to protect their family for their working years, the classic income replacement need, is sold a complex permanent policy. They end up stretching their budget to pay high premiums for a cash value account that often grows with mediocre returns and high fees. They are paying for a complicated financial product when what they needed was simple, cheap protection. For the most vast majority of people, term life is the appropriate, non-wasteful tool for the dependence and debt problem. Fourth, you are overinsured. There's a balance. You need enough to cover your specific obligations: the mortgage balance, future college costs, income replacement for a certain number of years. Buying a policy 10 times larger than what you need means you are wasting money on excessive premiums that could be better used elsewhere, like actually investing or paying down debt. So how do you decide? You need to conduct a personal audit. Start with the dependency test. Ask yourself bluntly, who, if I died tomorrow, would suffer financially? Make a list. If the list is empty, you have your answer. If it has names, you proceed. Next, the liability audit. List all major debts and future obligations: mortgage balance, other loans, the estimated cost of your children's college education. Then, the asset assessment. What do you already have that could cover those liabilities? Existing savings, retirement accounts, current investments, and any group life insurance you might have through work. The gap between your liabilities and your assets is the rough amount of coverage you might need. And finally, the affordability and suitability check. If you need coverage, get quotes for a term life policy for that amount, for a term that lasts as long as the risk, like until your kids graduate or your mortgage is paid off. For a healthy 30-year-old, a 20-year, $500,000 term policy can often cost less than $30 a month. If that premium fits comfortably in your budget to cover a catastrophic risk, it is likely an excellent, non-wasteful purchase. If the only product being pushed on you is a complex permanent policy with a premium that strains your finances, that is a major red flag. So what is the honest truth? Life insurance is a waste of money if you are buying it when you have no genuine financial risk to transfer, or if you are buying a needlessly complex and expensive product for a simple need. But life insurance is the opposite of a waste. It is a prudent and powerful tool when you use it to solve for a specific, catastrophic financial risk that your death would pose to others. The true waste, the devastating financial loss, can be in not having it when you desperately do. In the end, when used correctly, life insurance isn't really about death. It's about continuity. It's about making sure a family stays in their home. It's about ensuring a spouse has options in time. It's about guaranteeing a child's education continues uninterrupted. It is protecting a business you built. It is a financial mechanism for honoring your commitments and your love even after you're gone. And that, when you need it, is never a waste of money.